Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Performance Metrics. Asset-Liability Management performance metrics are critical tools in managing financial institutions' balance sheets. ALM involves strategizing to balance assets and liabilities to mitigate risks associated with liquidity, interest rates, and foreign exchange rates. Effective ALM ensures financial stability and efficiency, facilitating optimal decision-making processes and sound financial health. The performance metrics used in ALM provide insights into the institution's financial standing and guide strategic adjustments. The primary objective of ALM is to manage risks that arise due to mismatches between assets and liabilities. One key metric in this domain is the net interest margin, which measures the difference between the interest income generated by assets and the interest paid on liabilities. NIM is a critical indicator of a financial institution's profitability. A higher NIM indicates that the institution is effectively managing its interest-earning assets and interest-bearing liabilities to maximize profit. For instance, if a bank's interest income from loans and investments significantly exceeds the interest expense on deposits and borrowings, it reflects a robust NIM, suggesting efficient ALM practices. Another vital metric is the liquidity coverage ratio, which assesses an institution's ability to meet short-term obligations. The LCR requires banks to hold an adequate level of high-quality liquid assets that can be easily converted into cash to meet liquidity needs during a 30-day stress scenario. This ratio ensures that the institution maintains sufficient liquidity to withstand financial stress, thereby promoting stability and confidence among stakeholders. A high LCR indicates a strong liquidity position, whereas a low LCR may signal potential liquidity risks that need to be addressed promptly. The net stable funding ratio is another crucial metric that complements the LCR by evaluating the stability of an institution's funding over a one-year horizon. The NSFR aims to reduce funding risk by ensuring that long-term assets are funded with stable sources of funding. This metric encourages banks to maintain a sustainable funding structure, reducing the likelihood of liquidity crises. A higher NSFR reflects a more stable and resilient funding structure, which is essential for long-term financial health. Interest rate risk is an inherent part of ALM, and the economic value of equity is a key metric used to assess this risk. EVE measures the sensitivity of an institution's net worth to changes in interest rates. It provides a comprehensive view of the potential impact of interest rate fluctuations on the institution's economic value. By analyzing EVE, financial institutions can identify vulnerabilities and take proactive measures to mitigate interest rate risk. For example, if a bank's EV shows significant sensitivity to rising interest rates, it may consider strategies such as interest rate swaps or hedging to reduce exposure. The duration gap is another important metric for managing interest rate risk. It measures the difference in the duration of assets and liabilities. Duration is a measure of the sensitivity of the price of a financial asset to changes in interest rates. A positive duration gap indicates that assets are more sensitive to interest rate changes than liabilities, exposing the institution to potential losses in a rising interest rate environment. Conversely, a negative duration gap suggests that liabilities are more sensitive, which could pose risks in a declining interest rate scenario. Managing the duration gap is essential for maintaining a balanced and resilient balance sheet. Credit risk, another critical aspect of ALM, is measured using metrics such as the non-performing loan ratio and the loan loss provision ratio. The NPL ratio indicates the proportion of loans that are in default or close to being in default. A high NPL ratio signals potential credit risk issues, which can undermine the financial stability of the institution. The LLP ratio, on the other hand, measures the reserves set aside to cover potential loan losses. A higher LLP ratio suggests a prudent approach to managing credit risk, providing a buffer against potential loan defaults. In addition to these traditional metrics, advanced analytical tools and techniques such as stress testing and scenario analysis are increasingly being integrated into ALM practices. Stress testing involves evaluating the institution's resilience under extreme but plausible scenarios, such as economic downturns or financial market disruptions. By simulating adverse conditions, stress tests help identify potential vulnerabilities and guide the development of contingency plans. Scenario analysis, on the other hand, explores the impact of various hypothetical scenarios on the institution's financial position. These techniques provide valuable insights into the potential risks and enable proactive risk management. The integration of technology and data analytics has further enhanced the effectiveness of ALM performance metrics. Advanced data analytics tools enable institutions to analyze large volumes of data in real time, providing more accurate and timely insights. For example, machine learning algorithms can identify patterns and trends in historical data, helping to predict future risks and opportunities. Additionally, the use of predictive analytics can enhance decision-making by providing forward-looking insights into potential risks and their impact on the institution's financial health. Despite the advancements in ALM performance metrics, challenges remain in effectively managing risks. One of the primary challenges is the dynamic nature of financial markets and the evolving regulatory landscape. Financial institutions must continuously adapt their ALM strategies to keep pace with changing market conditions and regulatory requirements. For instance, the implementation of Basel III regulations has significantly impacted ALM practices by introducing stricter capital and liquidity requirements. Adapting to these changes requires a comprehensive understanding of the new regulations and their implications for the institution's balance sheet. Another challenge is the need for effective communication and collaboration across different functions within the institution. ALM requires a holistic approach that involves coordination between various departments, including risk management, finance, treasury, and business units. Effective communication ensures that all stakeholders are aligned with the institution's risk management objectives and strategies. It also facilitates the timely identification and mitigation of potential risks, enhancing the overall effectiveness of ALM. In conclusion, ALM performance metrics play a vital role in managing the financial risks of institutions. Metrics such as NIM, LCR, NSFR, EV, and the duration gap provide valuable insights into the institution's financial health and guide strategic decision-making. Advanced analytical tools and techniques, along with the integration of technology and data analytics, have further enhanced the effectiveness of ALM metrics. However, challenges such as the dynamic nature of financial markets, evolving regulatory requirements, and the need for effective communication and collaboration remain. By addressing these challenges and continuously refining ALM practices, financial institutions can achieve financial stability and resilience, ensuring long-term success. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UExcel, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.